Yesterday, Goldman Sachs raised its price forecast for gold for the end of 2025 to 3,100 per ounce, up from its previous estimates of 2,890. The adjustment reflects the bank's expectation of sustained central bank demand driving the market higher. Significantly, that means China is once again surprising with the purchases they're making. And they're not making those purchases in the public market. They're making them in the London OTC market, which is, again, emptying the basket of gold that's available.
Welcome to the Morning Markets and Metals with Vince Lancy, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lancy, and today's market rundown, we will be covering gold's new all-time high on Goldman's target raise to 3,100. It's not insignificant considering how much lower it was a month ago. But first, let's start with the markets. The dollar is up 11 at 107.13. The S&P 500 is 61.25 down a handle. The VIX is 15.46 up 11. Gold is 29.39 up 4 and change, bouncing around between down a buck and up 10 or $11. So we're in the middle of the range. I think the sell-off is done for now, for the moment, for the hour, and now you're probably going to see the market rally headed into the New York Open. Silver 32.93 up 7 cents. Copper 4.58 up almost 2 cents. WTI 72.79 up 63 cents. We're watching oil again. Natural gas 4.28 up 15. Holy crap. Bitcoin 96 and change up 662. Palladium 987 up 3 and change. Platinum 976 down 8. Gold, silver 89. Soybean 1038. Corn 4.99. Wheat 6.14. And you can see the changes. Wheat's down. The other two are up very marginally. All right. What are we going to talk about today? Well, I'm going to talk about gold. Can't get away from it, right? But that's what we're here for. There's the front page. Goldman's 3,100 target re-raise. The basket of balls there is symbolic of many things. The LBMA basket is getting empty. The LBMA is losing its balls, so to speak. Unlocked, latest developments in the gold reset. That's an audio of everything that's been happening over the last, say, 4 days, and the gold fix gold monetization thesis. Let's start with our own work posted yesterday. News and analysis, just in, Goldman's target is raised. There you go. Ain't talking about gold. That's the morning rundown from yesterday, which alluded to several topics related to the precious metals. And a geopolitical note we put out commenting that as Trump's efforts to wind down the Middle East and Ukraine take root, you'll probably start seeing an escalation in Taiwan. And it's kind of like 2 ships passing in a night, or 3 ships in this case. And the founder is a little bit more in depth on the Goldman report. Let's go right to the discussion. Gold's new all-time high. You see the headline there. Goldman Sachs raised its gold price forecast for the end of 2025 to 3,100 per ounce, up from its previous estimate of 2,890. The adjustment reflects the bank's expectation of sustained central bank demand driving the market higher. More on that in a minute. Structural demand from central banks. Goldman estimates that a structural rise, quote, a structural rise in central bank demand could add 9% to gold prices by the end of 2025. The bank increased its central bank demand assumptions to 50 tons per month, up from 41 tons. That's significant. I'll tell you why later on, but that's a significant, that's not a 9-ton increase. That's a 9-ton increase on a 6-month moving average. That's big. Should monthly purchases average 70 tons, Goldman sees gold reaching 3,200 per ounce by the end of the year. Staying in that story, there's a chart. We'll go through this chart in a second. The rate path and uncertainty scenarios. Goldman outlined multiple scenarios for gold's trajectory outside of the physical demand, citing Fed policy, tariff risk, and U.S. ETF demand, all in addition to continued surprising central bank demand at these levels. Buy recommendation reaffirmed. Goldman reiterated its buy recommendation, buy gold trading stance. The bank emphasized gold's value as a hedge against risks such as trade tensions, potential Fed policy missteps, and recession threats, noting these could push towards the upper end of its uncertainty range. So trade tensions, tariffs, they're quantifying this. They're not just saying, they're not just throwing it out there anymore. Potential Fed policy missteps, easing, not easing, hiking, and recession threats. Well, that's kind of lumped under the Fed one. The reality, the other three drivers really are Fed policy, which is what we just described there, tariff risk, that's your trade tensions, and U.S. ETF demand. Okay, so the U.S. ETF demand, I guess you could lump under recession threats. So Americans are buying gold in ETF form again. How will that play out? Let's take a look at this chart for a second. Now, not that big. See if I can make it bigger for you. There you go. Now, this report has a ton of good charts in it, charts that you haven't seen before, charts describing China's physical demand, its effect on the market. And this is all tied to the better bullion banks, and by better, I would say more frank with their analysis without giving away the house, would be Citibank. Believe it or not, I'm saying better. I don't mean better. You guys know I hate you. Citibank, Bank of America, and Goldman have all come out and said, okay, look, we admit it. Gold's got to be priced based on physical demand, not based on your correlation or that correlation or some other neo-Keynesian statement. And so they started explaining their rationale. This amount of gold bought means that percent. And in doing that, they all gave different flavors of the same type of concept. But in doing that, Goldman's visual here is an example of that. Okay, the light blue line, the Goldman Sachs prior forecast, was based on X amount of gold buying by central banks. This is after the new year, right? Okay. The red line is the new forecast that's based entirely on a reassessment of central bank demand. Now, this is extremely important. Just to touch on it. The central bank buying had been at lower levels and before the U.S. election. We're now after the U.S. election, right? And we're now after the BRICS summit. We're now after Trump is in, and the prices are significantly higher. Yet the central banks are buying at higher prices. They're not doing what they normally do. I'll buy some down here, right? I'll nibble, right? They're basically picking levels and raising the floor actively. A concept we talked about here for a while, that raising the floor back then was based on producers aren't selling as much. And if they're not hedging as much, then it's harder for bullion banks to cover. And so they're going to cover at higher levels, which you've seen. But there's a confluence of events going on, which I'll get into another time. But I want to draw your attention to the light blue line, the little swoosh down there, hockey stick, and the red line are a change based solely on physical demand from central banks who are now buying it at $2,800 an ounce, $2,900 an ounce. And if you think it's just China, you're out of your mind. So that's the beauty of that chart visually, if you really look at it a little bit. There's plenty more that show the demand and all that. We'll talk about that more. All right. Did I get ahead of myself? Okay, so I'll go into this a little more meat on this at the bottom, right? At the in premium afterwards. But for now, I want to go to market news. Last week, I sat down with Sean Newman and Nick Moreanis, Sean Newman of the Sean Newman podcast and Nick Moreanis of the Silver Gold Bull. And I sat down, I was like, oh, we're going to talk about gold, right? And of course we did, but it was about Canada and tariffs. And what was top of mind for Sean's viewers and for Nick is as Canadians, like, what the hell's going on with these tariffs by Trump and how serious or not serious is he, et cetera, et cetera. It was hard to get a handle on it. And one of the things that I had said was uh, I think Trump's tariff vibe goes from general to specific. So we're tariffing this country, we're tariffing this country except that item. And then the pushback comes and he gets his polling, what's the pushback? Oh, oil went up. Well, we can't tariff oil, right? Stocks went down. Well, we can't tariff China yet. Uh, anyway, you start picking out specific items and you pick out items that do not affect the US, protect our industry, and probably hurt other countries. So, for example, you tariff steel. Well, let's say we don't import steel. Great, I'm going to tariff the world steel. You don't really cause inflation to us because we're not importing it if he does it right, but you will affect nations that export steel. So I'm going to tariff Canada. Well, you can't. I mean, you can do that if you want, but you can't do that. And if you do that, you make it harder to get the next thing you need. Like we'd like to have one of the things that Sean and Nick brought up was, well, we've got some natural resources and we're close to you. And there's that Arctic Circle thing that you guys are worried about now. You know, be a little bit nicer to us. I mean, they weren't being pushy about it, but that's the point. Anyway, that's the background to this. I want to read. This came out yesterday. Trump on Tuesday said he was considering tariffs of 25% or more on automobiles, semiconductors, and pharmaceutical products. Now, those hurt nations that sell them to us, but who do they hurt most? Well, semiconductors and pharmaceutical products. That's directed at, it's directed at countries that rely on those. And I think you're looking at China. So, do we import China semiconductors? No, but it works its way back to them. Tariffs will be in the neighborhood of 25%, quote, on those industries and may increase over time, he told reporters at his Mar-a-Lago club in Florida. He added they will go very substantially higher over the course of the year. Trump also said companies in the U.S. may be given a phase-in period on items they import, giving them time to move production to the U.S. He said he would allow a little bit of a chance to reshore production. Okay, that's negotiation. There you go. So he's going to go after items, right? And hopefully he'll pick the right items, right? I'm not anti-China. I'm anti, what do we import from China? I'm anti that. It's not just China, it's everyone else. It's cover, it's how you do it. And then the other stories are also significant, but I'm not going to go into the detail into them except to say Elon Musk, it's beautiful, right? So the U.S. announces Stargate. This is about AI. The U.S. announces Stargate. China announces a deep seek, right? Which immediately makes Stargate look like a bad investment and says the U.S. is investing too much money in it. We're doing it cheaper. We sell it cheaper. The U.S. tech market is overhyped by China's talks. And that's an attack that pissed Trump off. It happened right after his big Stargate announcement. So it's interesting how there's a war going on right now. Musk and Trump and Bessent and Lutnick, they get together in Mar-a-Lago and they go, all right, so what's our counter to this? And they have their immediate counters, but Musk says, you know what? If they can do it, I can do it. And so Musk announces its latest artificial XAI's artificial intelligence model, Grok 3, claiming it can outperform offerings from OpenAI and China's DeepSeek based on early testing. And it's going to have a new product called Deep Search. So you're in an arms race, right? It's an arms race on tech. And well, this is how you do it. Right? We're at war with China right now, economically speaking. And then Howard Lutnick was confirmed as at the Senate Tuesday to be President Trump's Commerce Secretary. Important because that's a guy who's pro-Bitcoin, sovereign wealth fund, Scott Bessent. We're gonna monetize gold. We're gonna revalue assets, and then we're gonna take that money and we're gonna do something with it. And Howard Lutnick's gonna be there. Like, well, why don't we buy treasuries? See, Howard Lutnick's a bond guy, and why don't we buy treasuries? And why don't we tie them? Why don't we what do you call it? commit them to Tether, right? And buy Bitcoin with. I mean, it's all there. There's a plan here, right? And then you have Intel's Taiwan semiconductor rivals and Baidu and what have you. So it's all happening. Middle East. Uh, Israel Minister of Strategic Affairs Dermer will work with U.S. Special Envoy Witkoff on phase two talks. So peace in the Middle East is actually making progress. Ukraine, Europe, same idea, but I'm not going to read it now, but it's really good. Uh, how's this? President Trump takes a dump on Zelensky's head. That's what it is. He's basically, uh, putting him at the kids' table during this discussion on Ukraine. All right, next data on deck. Today's Wednesday. Housing starts. Minutes of the Fed's January FOMC. Oh yeah, that's right. 2:00. Fed minutes come out. That could have an effect on the market. So you want to see what's going on before then. But I don't really think it's going to have a big effect on gold and silver. Before we go to premium, let's take a look at the charts. All right, on the left is WTI, on the top right is silver, lower right is the dollar, and lower left is gold. WTI, I care about WTI right now simply because, wrong chart. Well, the right chart, but not the chart I want to talk about. WTI this is a sign of a congestion, and it could be there for a long period of time, and the moving averages start to convey that. They start to dance back and forth, and nobody cares about it. They will care about it, but they don't care about it right now. So you're like, why am I looking at it if it's not going anywhere? Because I trade options. It's butterfly time for me. I might be buying an out of the money call, selling and buying it in the money call, and selling two at the money calls. It's a volatility trade. I'm betting on sideways. I haven't done it yet. Silver. I was long silver. Got out before the big spike. And why do I have it set there? Oh, yeah, here we go. There's a pattern that we've been seeing in gold all the way up. And I really haven't seen it in silver, but this is one of those patterns in silver. And the pattern is the measured move. It's not necessarily a V-shaped bottom, but it's a dump. An orderly buyer comes in. It breaks above this line. Think about gold. It breaks above this line, and then you have what I would call a measured move. We just had one in gold. Gold dipped. Boom, and then I said it would go to 28.95, which it did, and 2,900 give or take, and then now it's 2,950 and 3,000 based on the measured move concept. But I'm not predicting those. I was saying that's what it is. Incidentally, I was short gold, and I covered yesterday above 2,907. I'm now long naked GDX and short tech against it. But staying with silver here. So here's one of those patterns in silver. I'll show it to you. Here's your depth, right? There's your orderly, careful, smart buying. There's your blowout. It's almost like the BIS sold it here. And maybe they did. Who the hell knows? But now the market is above this area. So I'll just give you a little visual of that, right? So there's the bottom. There's the measured move rule says depth equals distance, or depth equals height, depending on how you look at it. It doesn't give a time frame, but basically, as long as we stay above here, we should go there. Now, I have a problem with this, even though I'm buying into it. The difference between this and one that we've seen in gold is when these occur in gold at a high, whether it be a daily high, a weekly high, a monthly high, they work very well. This structure here is troubling. Not bearish troubling, but troubling. So I'm going to give you a little refinement. The trade, I actually bought gold this morning too. So I bought gold on silver because silver is just too volatile for me to handle right now. Above here, silver should go to there. So if that's my rule and we're in it, it's a great trade. Why? Because this could be where it stops. So you take your level here, and then you drop and you put another level here. You put three levels in. All right, if you're a technical trader. You go like this, you go, this is the market. This is a range from here to here. We broke out of the range. We should go to this level. If we get above this level, which is a whole new little structure there, that's a little like hanging out, double distribution. We get in there, we should traverse to the top of it. And if we get above that, we go to there. So I'm looking at it like this. I'm long, right? Not long silver, I'm long gold right now. I'm long above here. I'm long gold as long as silver is above there. Crazy, right? But that's what I want, right? If it gets above here, I might add, right? I certainly won't subtract. If it gets into here, once it gets above here, I might start selling calls to hedge my length. So I'm long calls right now in gold, and I'm long GDX, but I'm long some calls now in gold as well. So as we get to here and here, I might start selling another call and creating a call spread. So there's a plan right now, and it's based on the fact that I lost money yesterday, and I'm happy to do it because it gives me an opportunity to make it higher. So, and if the market sells off, I'm wrong. But there you have it. So silver is my indicator to trade gold, where you could just do what I'm talking about in silver right now. And I'm sure Michael Oliver will be like, yeah, you should just buy silver. He's probably right. But I want to do options right now, and silver options are not liquid enough for me. Gold, here's the measured move from here to here was the depth. And then it went above there, right? It stopped the first time up, then it went above, and now the measured move is to 28.95. That's like basically this depth, and we have it, and we're still going. So now you can make the case, if you're fractally looking at this, this could be a measured move from here to here. So we go from here, 28.76 to call it 29.25, so $50. So $50, 29.75. So 29.75, 3,000. 3,100, a billion, all these things are on the table. And I'll tell you a secret about technical analysis another day. I don't want to shit on it right now. But that's it. So stay with me, and we'll go through more of this in premium. But just to recap what we talked about today. Yesterday, Goldman Sachs raised its price forecast for gold for the end of 2025 to 3,100 per ounce, up from its previous estimates of 28.90. The adjustment reflects the bank's expectation of sustained central bank demand driving the market higher. Significantly, that means China is once again surprising with the purchases they're making. And they're not making those purchases in the public market. They're making them in the London OTC market, which is, again, emptying the basket of gold that's available. There you go. All right, I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lancy. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.